2022. Thank you for joining our 2022 market update and outlook. Again, for those who haven't met, Eric Walters, managing partner. Today we're going to talk about the economy. We'll talk about the stock market, particularly also the recent volatility. We'll talk about inflation. We'll also talk about how investors and business leaders can respond. I hope this is beneficial to you if you are a retiree and looking at your portfolio, if you are a business owner, if you are a business leader, or if you're just interested about kind of what's happening in the stock market. Love to kind of engage you. I'll share some information just about our agenda here, and I almost always gets questions about the slides. So if you'd like a copy of the slides, I'm happy to share them. We use publicly available information here. So you can email me at info@summithillwealth.com, and I'm happy to share that. First, for those of you that don't know Summit Hill Wealth Management, we are a boutique wealth management firm. We manage the finances for successful families. Most of our clients are business owners and executives. Really, our process is customized to clients in general. We create a plan for how they can enjoy their lifestyle while preserving and growing their wealth. We help them with their investing. And then we also coordinate with their other advisors, such as their CPA, their trust and estate planning attorney. And we also look at protecting them from bad things that could happen, whether that's disability, premature death, lawsuit, need for long-term care, things like that. And then if appropriate, if they'd like, we also work with their children and help prepare those children for multi-generational wealth. Why does that matter? We think as people become more successful, it creates complexity and creates missed opportunities and unexpected risks. I won't go through all these, but these are the topics that we help clients navigate. So if you're interested, again, our contact information is info@summithillwealth.com. So I thought we could just start by looking at our themes for 2022. We don't claim that we can predict the future, but we are able to look at data and get a pretty good idea of what the data is telling us and look back at history. Our approach is data intensive. I've tried not to create too many slides, but there's so much good data out there. So you'll notice frequently I'm referring back to data. I think that's one way as investors that we can ground ourselves in our decisions. And so first we'll talk about that most developed economies are in mid-cycle growth. This is positive for investors, but it does mean growth is slowing. We have been expecting higher volatility, and it looks like it's here. It looks like inflation has a good shot of moderating later this year, but it could be elevated. We'll talk about our outlook for that. Higher interest rates can certainly be a headwind. We'll talk about why that is and how stocks and other assets have responded, and what kind of portfolio diversification we're using. So we'll get started. But first, I'd love to just make sure that as our participants know, if you have a question, please type it into the chat. I will pause and just answer questions. And so as I begin this, I would love for you to type into that chat box what is your greatest concern for 2022, whether it's regarding the business cycle, whether it's regarding investing. So down somewhere on your control bar, you should have an opportunity in chat, excuse me, and I would just love to see what your biggest concern is as we get into this. So I'll start looking into this and we'll pause and see what people are typing in there. So when we think about how the stock market has responded, this year, what I'm hearing from a lot of clients is, boy, a lot of volatility. I always think it's helpful to take a step back and just think what happened in 2021. And in 2021, you can see that U.S. stocks and real estate really dominated. U.S. large cap stocks up 29%, small cap up 25%, and real estate up 45%. Really doesn't get much better than that from an investor standpoint, but it wasn't unified across the board. You can see international stocks struggled plus 1% for developed, and then emerging markets, down 6.5. Investment grade bonds started to respond to rising interest rates and slightly negative. Gold was negative, which is a big surprise. A lot of people thought gold would really shoot up, maybe 20 or 30% on concerns about inflation, and that just did not happen. Managed futures did pretty well. Hedge was about flat. So when we look back, it wasn't uniform, but if you had exposure, again, to US stocks and real estate, you probably had a great year in your portfolio. But year to date, we've got the reversal happening, and this data was as of the 24th. So the market was down yesterday. It's already back up today a little bit, but these numbers are approximately correct. Large cap is down, small caps to down, developed international down, emerging markets surprisingly is flat. We'll talk about that. Real estate flat, gold up slightly, managed futures up slightly, hedge up slightly. So what this shows is just kind of a rotation to safety. This is really common market dynamics as the market is concerned about something. We'll talk about those somethings, more, but really we're just looking at a normal kind of pullback. I say normal in the sense that, about 40% of the time, the market pulls back within a given calendar year by about -8 to 10% from a recent high. And so I like to say we're from Colorado. This is almost like a hailstorm or a bad thunderstorm. It's scary, kind of shakes the house, but it's very, very common. So from an investment standpoint, should we be concerned? At this point, no, but we will talk about I think the threats and the things that have investors' attention. So far, this seems more like a pullback, but we'll just have to see if this gets into what's called correction territory when stocks are down -20%. So far, they're down, kind of -7, -8%, depending on how you measure it. So when we look at how stocks have weathered rising interest rates in the past, those periods of rising interest rates, actually stocks have done pretty well. And that's, the first thing that I think investors have been paying attention to. The Federal Reserve have basically said, we're going to start raising interest rates to deal with inflation. And just a quick economics, background, that if inflation is kind of running rampant through an economy, it certainly seems like it has been, probably you could argue last 3 or 4 months, but for many people in many sectors of the economy, more than that. But inflation is higher than it's been in multiple decades. Depending on the month that you look, it's up, anywhere between 4 and 7% year over year. So with higher inflation, that means more and more money and more consumers and buyers are chasing more goods in general. And if you raise interest rates, that generally lowers the demand for money. It kind of increases the cost of a lot of projects, increases the cost of borrowing, and that tends to dampen down demand. And then the hope is that will reduce inflation. So that's why the Federal Reserve is talking about raising interest rates. And in the past, when we look at these, last examples, how have stocks done in this rate raising cycle? In general, they've done pretty well. There's a exception with 1972 and 1974. But in general, stocks have done pretty well. So that's one takeaway for an investor, that although stocks will be volatile in periods of rising interest rates, companies themselves generally have the ability to pass on price increases of their raw goods to their customers. And so if you have a well-diversified portfolio, I always recommend large, small companies, US and international. In general, they could go through periods where their cost of goods is higher, their profits may be less, but in general, they'll pass that along. So in general, stocks actually do pretty well kind of dealing with rising interest rates and also the related inflation. Now, eventually, interest rates can get high enough, it usually leads to a recession. And of course, stocks will struggle then. But during the cycle, while that is happening, from an investment standpoint, stocks are actually not a bad place to be. And I think that's one that's counterintuitive for some investors. Now, I mentioned about kind of how common it is to experience pullbacks within a year. And so there's some data here on the right-hand side of the chart that just shows, what happened in a given year for kind of these pullbacks. And you might notice that these years correspond to these periods of rising interest rate increases. So when we look at these periods of rising interest rate increases, what was the pullback that the stock market experienced during that time? And then what happened, for that year's return? And so I think the data here is really compelling. If you look at, for example, in 1955, a market down, it looks like about 11, 12%, ended the year plus 30, right? There's another example in 1962, down here, ended the year, negative, but certainly recovered quite a lot. And you can see other examples where the stock market was down within the year, but then ended positive, whether that was a little bit positive, like in 92, or much more positive in 96. I think the takeaway for an investor is that those early stages of interest rate increases don't have to be a concern. we can look at companies and say, if the companies are doing what the stock market expects them to do, right, which is to generate revenue and generate profits for shareholders, then part of that is raising their prices for their customers. And so even rising interest rates will create volatility. That's very common, but it doesn't mean that the year is lost. And so to go back to the prior page, even though we've started the year poor, we could actually see stocks go down much worse. We could get down to -10, -15%, and it would actually match kind of the historical pattern of how stocks have performed. And it doesn't necessarily mean that the year is lost. In fact, many times the year may begin poorly, or the stock market may struggle in this new kind of phase that we're in, but actually end up okay. So I think it's the first lesson for investors is don't write off the year. Don't really catastrophize. One, because companies can pass on cost increases. Two, because history would say that it actually can handle whether rising interest rates pretty well. So let me pause. I know I asked people to kind of type in chat, what were you concerned about? So let me just take a look at it. Chris says higher interest rates and volatility. Great point. We will talk about that. Jason says equity valuations seem extreme. Impact of rising rates will be nowhere to hide. Great point. So we will talk about both of those. So thank you. And if you have additional thoughts about what you are concerned with, we would love to kind of put them in there. Sorry, I'm just moving my slides here. Okay. I mentioned the impact, or excuse me, I mentioned the framework of where global economies are right now. And I think it's really important as investors that we take a step back and see, well, what's happening with the economy? And so you can see this slide here, and this is produced by my friends at Fidelity. I think they do a great job. And what they've done is basically looked at the data for each of the major economies and kind of said, where is the data telling us that the economies are kind of in this cycle of economic growth? And for those of you that haven't seen this before, there's usually an early phase of an economy coming out of recession, when usually activity is quite robust. There's usually a lot of demand. There's a lot of sales. Usually it's very profitable. Companies can charge sometimes kind of whatever they want. There's a lot of demand here, and the policymakers usually have interest rates and policy still very stimulative. And there's often a mismatch between inventories and demand. So it's not unusual to have bottlenecks. When we look back since the COVID period, that's certainly what we've experienced, right? We've had a huge uptake in GDP, in consumer sales, industrial production. Of course, there's been huge bottlenecks. That's very unusual. We've had a natural disaster kind of unlike any other, and inventories have been really low. So it's been right to script. But the data shows that we're now in this mid-cycle phase. And you might notice one of the first things that is showing is kind of growth peaking. And so, both industrial production, which is kind of what companies produce and sell to other companies and also to us, will probably peak sometime in the middle of this year. And it will still go up. So just the absolute numbers will still go up, but the rate of growth will slow. And that also will apply to retail growth. And profit margins usually start to come under pressure here, and profits usually start to decline in this phase of the cycle. And in this phase, usually policy is neutral, and there's a better, kind of balance between inventories and what people and companies want. It's not always at equilibrium, but there's more of a balance. So when you look at that data, you can say most of the developed countries and even many of the emerging countries like Brazil and India, for example, are in this mid phase. And what does that mean for investors? It means that underneath the volatility of the stock market, things look pretty good for the economy. You've got unemployment that's coming down, down, down. That means people are still going to be spending. You've got still, I think, somewhat of a rebound from COVID, where people do want to travel. They do want to get back to life to normal. So whether that means going out to eat or, spending, there's still that demand. So it's, it's kind of a positive kind of backdrop. But this phase is also where you traditionally get these kind of pullbacks in the stock market. And a pullback, again, can be kind of -10% from a recent high, even up to -20, which that's technically kind of correction territory. But it's kind of -10, -10, -20 is very common. And so investors usually, as they transition into slower growth and more stimulative or more restrictive policies, generally will have a little bit of tantrum and try to figure out, is the Federal Reserve going to be really nice to us and stimulate the economy, or are they just kind of let us go through this? And that's exactly what we're experiencing. The stock market and stock market investors are wrestling with, should we be defensive? How exactly aggressive is the Federal Reserve going to be? And what's interesting about this phase of the mid cycle is that it has some aspects of it that are more common in late stages. So, for example, inflation is coming on earlier in the cycle than it normally would. Labor force kind of tightening, in terms of just hard to get people, is happening early, earlier in the cycle. And then also the Federal Reserve is talking about being more restrictive earlier in the cycle. So this cycle, it seems to be going faster than historical, and that's okay because, again, we're recovering from a natural disaster. Now, some of you may also notice that China is all the way on the other side there. And that's just because China has taken a zero tolerance approach to COVID. And they're basically saying, we don't care the kind of the impact of this. We're going to lock down entire cities. We're going to restrict kind of the ability for people to move about. That's having, a real impact on their economy. And it probably will have some add-on effects to other economies. A lot of our supply chain issues can be traced back to goods kind of waiting in ports in China or, kind of factories in China to start up. And so their approach could affect us. But they've already said that, the People's Bank of China has already said that they will lower interest rates. They're trying to stimulate the economy. So I don't think that's a huge threat to the rest of us, but it could be kind of a headwind. So that's the kind of economic background. And again, it kind of puts market volatility in context. And I always like that framework because otherwise, as investors, you can be tossed back and forth just by the headlines. Is inflation going to crash us, or crypto markets or currency? It's important to kind of see where are we. So we talked about the stock market returns. We talked about, sorry, my slides are taking a second. We've already talked about how stocks have weathered rising interest rates and pullbacks. One other headwind that we should be aware of is something called the presidential cycle. The presidential cycle is a pattern in stock returns that, is not always, accurate, but there are some patterns that seem to be persistent through the years. And so the presidential cycle is just a pattern of how the stock market has performed in different years of a president's term. And often in the first year of a president's term, the market also often does pretty well. And you think about this, it's kind of psychological. The president and often Congress, but not always, is interested in doing something. They've been elected. They're going to try and stimulate the economy or lower taxes or sometimes increase taxes or something. And usually it's kind of a crowd-pleasing move. They're kind of, hey, I was invested, I was elected, and I'm going to do something that's going to be positive. And often that sends a positive signal to the stock market. There's often going to be less taxes, which more money for people and corporations to spend, or there's going to be more government spending, which is also going to kind of move. The second year of a presidential cycle is usually marked by gridlock, disappointment, and things that don't happen, and some tough policy decisions. That's often kind of the second year. And that's exactly what we've been experiencing, right? You see kind of Democrats, goals are kind of stalled out. And, you can look at what the intra-year declines have been in the presidential cycle. So the black mark here, or the black here, shows how common it is for the stock market to pull back in the second year of the presidential cycle. It's very common. In fact, it averages negative 17%. But the returns, a year later are incredibly positive. Those are plus 32% on average. So if you're an investor, it's good to know that this cycle happens. But unless you're trying to trade the market, every couple months, you're going to get in and out. I think it's really just more, again, to put it in context. We've looked at the economy, what's happening there. We've looked at this, kind of threat of rising interest rates, and stocks do pretty well. And now we've got another kind of lens to look at, which is the presidential cycle. We say, oh, okay, this is really common. Now, one reason why year three is often really good is because usually there's been a midterm election, and often a president is kind of saying, hey, I've got to do something. I want to get reelected. Year two is, pretty challenging. So let's all work together. Let's try to get something done before we all kind of leave and start campaigning again, usually in January, February of the presidential election year. So often that year three is when politicians will decide, are we going to do something else? Historically, they often have, and that's usually positive for the stock market. We've got a chat here, so I'm just going to pause. And we've got a question about impact on business valuations. That's a great point. And a question on real estate. At what point do you expect rising interest rates to impact home prices? That's a great question. So I'm just going to pause and address some of these questions right now. So the impact on business valuations is a great point. Again, most of our clients are business owners, and you think about if you were going to buy a business, what would you want? You'd want a track record that looks pretty good. So everyone says, oh, we'd like to see profits and revenue kind of going up. And for right now, I think a lot of potential business buyers want to see not only how a business did through COVID, but also if they had unusually good results, if those can be sustained, if they had really bad results, if they're kind of going back to normal. So right now, I think a number of buyers are kind of saying, "Hey, we're thoughtful about looking at your historical returns through COVID because we're not sure what normal is for you." I just talked to a client last night who said that's what they're experiencing in their business. Potential buyers are looking at them and saying, "We don't believe your results through COVID." In this case, they think it's too good. So they may need another year and a half or 2 years to kind of show, "Hey, this is what our normalized rates are." But if you're a business owner, often one of the best times to sell your business is in this kind of mid-cycle where you can look back and say, hey, we made it through a tough time and we're doing well, but you give the buyer the benefit of some of the upside. And I'll go back to a prior slide to kind of highlight this. If you are buying a business and you're trying to sell it, many business owners, will kind of say, hey, I'm getting a sense that things are going to slow down. And that's usually in this late cycle. And if they go to market at that point, their buyers aren't dumb. The buyers have the exact same caution. And the buyers say, well, we can see the same concerns you can, so we're going to give you a discount on your business. Actually, often valuations are best at this mid-cycle because you can look back and say, I made it through, and then you can look forward and legitimately say, we think we have 2 to 4 years of good, kind of good path of growth ahead of us. And this is where you, as a buyer, get to benefit. And the buyers say, wow, that sounds great. We feel the same way. So if you're a business owner, it behooves you, if you don't yet have an idea of what your business is worth right now, you can contact me. We have some resources of people we can put you in touch with. They'll give you kind of a free idea of what your business is worth now. And they'll also give you an idea of whether you are kind of ahead of the cycle or lagging the cycle. There are some businesses that are ahead of the economy, some that are behind, and that has a lot to do, or that's a big impact of where you may want to say, hey, maybe I should go to market with this. So for Alexander, if you have a question about that, happy to follow up. Regarding real estate, if anyone who's been in the residential market knows, real estate prices are bonkers. Just in many growing cities, prices have doubled over the last 4 or 5 years. And I think it's related to a few things. One is after 2008 and 2009, many investors, of course, home builders were so badly burned by the role of real estate in that colossal crash that they basically said, we're not building any more homes. And so if you look at the data, the number of homes built from 2009 on to 2015 was way, 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 way below normal and way below our birth rate. So we are dealing with now kind of a housing shortage, just as millennials decide they want to come from the city into the suburbs. And this COVID really accelerated this. So we have a housing shortage based on the data I've seen. It's probably likely 4 or 5 years at kind of higher building rates before we could, kind of solve that. So one, there's just a shortage. But two, as the person asking the question said, low interest rates have made people able to stretch for a house they may not be able to afford. So if interest rates start to move up, mortgage rates start to move up. And so my best guess is that I think as mortgage rates start to move up, we're going to lose some of those incremental buyers. They'll say, well, we're not stretching for the $1 million house. We're going to try to go into the 750 house, or not 700,000. We're going to try to go to 500,000. So I think it'll probably put pressure on homes priced at at the higher end of the market, the real estate market. But those kind of more affordable homes, whatever that means for a given geography, probably will do okay. Eventually, interest rates could get high enough on mortgages that you see a real chill. But I think we're far away from that. I think you'd have to see mortgage rates probably between 5 and 7% before you start to see a real chill. But I think those markets, those higher end homes, will probably experience it first. And this is common in other downturns. So I'll move forward, but thank you for the questions. Those are great. So we've talked about the presidential cycle. Now let's talk about what I think so many people have talked about, which is inflation. Sorry, my slides are just a little slow here. So, as anyone knows, inflation is kind of spiking, and we've got two different measurements of inflation here. The red line is the consumer price index. The blue line is consumer expectations based on a well-known study, and both have spiked up quite a lot. And I think with slower growth this year, I think more and more consumers will be more price sensitive. I think that should lead to inflation being more moderate. And I've created my little dot here. This is just illustrative, but I think towards the middle part of this year, I think inflation should pull back. I think market volatility will often make people kind of pull back a little bit. I think people will be more price sensitive about restaurants, eating out, clothes, vacations, things like that. I think companies will have to adjust to that. So far, for the last year and a half, 2 years, companies have had kind of a pass. They could charge almost anything, and people would say, "Oh, absolutely, I'll go eat that." But what I hear from friends and just kind of anecdotally is people are saying, "No, I'm not going to go to that restaurant anymore," and that's just human nature. But I think what will happen is I think inflation will then kind of trend up and stay at a higher level than it's been at the past. Inflation has been kind of between 1.5% and 2.5% for quite some time. It's been in this kind of unusually low period. I think we're in for a period where that kind of level could be higher. And I'm guessing it's maybe around 4%. That's my guess. The reason why is that companies have had to pay more for people during this time. And companies can, kind of absorb that in the short term, but eventually they need to pass that on. And so I think what's going to happen is that companies are going to respond to consumers being concerned, but eventually those higher wage prices are going to have to push up prices higher. And wages are fairly permanent for a company. It's very, very hard for companies to significantly lower their wage costs. So that's my guess kind of on inflation. And so from an investor standpoint, what does this mean? I think the Fed will raise interest rates. They may pause, kind of later this year as they see maybe inflation is less. If inflation does kind of reset higher, and this could be 2023, 2024, the Fed may say, okay, we're going to have to keep raising interest rates. So I think even though we may get a kind of a short-term reprieve from an investor standpoint, it may kind of continue. I mentioned in my invitation that I was going to talk about a newer theory, economic theory about inflation. And why would we even be talking about this? The reason why is that current economic theories do not explain why there has not been inflation in some key parts of history. And so, this is a big deal because now, we kind of try to look forward and say, well, will there be inflation? Won't there? Is it going to come down and go back up, or what's going on? So I'll give you a brief overview. And for those of you who study economics, please forgive me, this is very brief. But if you'd like more, email me again at info@summitillwealth.com. I can send you the paper, go into details. But one of the classical theories, and for those of you who have studied theory, it's the quantity theory, and basically the money supply equals inflation, right? And that if you just add a bunch of money, then inflation is going to go up. And that theory has really helped economists kind of predict inflation, deal with inflation in many periods in history. It's largely true. If you just kind of print money, that's true. The problem is that after Japan went through its major bust in the late 80s, early 90s, there was no inflation to be found. Printed money, they lowered interest rates, they bought assets, they did everything. And still, economists are saying, I don't know what happened. But a lot of people have a home country bias, and they say, well, it's Japan. Doesn't matter. Let's see what happens. Well, then 2008 happens, and the Federal Reserve lowers interest rates, starts buying assets. Their balance sheet explodes. If you look at the quantity of money, it just was unusual. And you have all of these Armageddon predictions that in hyperinflation is going to start. We should all buy gold. The dollar is going to collapse. If you were investing or reading economic news in 2009 and 2010, this is all anybody heard about. And what happened? Nothing. There was low inflation. The Fed, for all of its, kind of inventions, could not get inflation to budge. And of course, financial assets kind of exploded. We had amazing markets. But why is that? So there's a newer theory called the fiscal theory of the price level. And what this does is it basically says, look, inflation is comprised of two things. It's not just the money supply, which is a liability of the government, whether the money is bonds or cash. That's a liability of the government. It's the money supply divided by future government cash and its willingness to basically tax, its constituents to pay for those liabilities. So the fiscal theory says, look, this is a little bit like value in a company or a bond. If a company says, I want to borrow some money, bond holders will say, well, do we think you can pay it back? If they think that company can pay it back, they'll basically loan the money to the company and usually offer them a low interest rate. If they don't think the company is going to pay it back, then they're going to say, well, I don't know, we're not going to loan it to you. We're going to require a higher rate. So this theory basically says that investors all around the world are the same way. They basically look at these two things and they need to work in tandem. And so this is, I think, fascinating because it's government surpluses after interest payments. And so when we look at this, what would drive inflation higher in this model? Well, the first thing is if the money supply increases without the government either cutting spending or raising taxes. And that did not happen after 2008. Actually, there was a lot of talk about austerity in 2009 and 2010, if you remember. So that didn't happen in 2009, 2010. And then what else can drive inflation higher on the lower part here? If interest rates go up, that affects how investors will value future cash flows. So it looks like interest rates may move up, so that would affect future cash flows. If the government had voluntarily, kind of decreases its revenue through tax cuts, or it increases spending without changing the money supply, that would cause inflation, or the debt interest payments increase because of higher interest rates. Well, what do you know? All four of these things may be in play right now, and they were not really in play in 2008, 2009, and after the Japanese bubble burst. And after the Japanese bubble burst, I think investors basically said, we believe that Japanese policymakers will continue to, kind of collect taxes. But now we have basically after COVID, we had a money supply that, increased quite a lot, but there was no change in government spending and really no kind of plan to raise taxes. Interest rates may go up, which would increase interest payments. And, as I already mentioned, increased spending. So we have, kind of an interesting scenario that's unusually different than 2008, 2009. And this theory may explain why. So why am I bringing it up? I think it lends credence to this idea that inflation higher than recent history, historical inflation level may be with us for a period of time, that it's not just the quantity of money, it's how investors believe that US policymakers, will they collect enough taxes to pay for it? And I think for quite a long time, investors said, yeah, absolutely. But lately, with the Tax Cut and Jobs Act, with kind of proposals for infrastructure spending, and with the deficit going up quite a lot, and those deficit interest payments going up quite a lot, this theory would say investors may have some concerns about that and may push inflation higher. So I just bring that up as a theory. Again, it's called the fiscal theory of the price level. If you're interested, I'm happy to send the paper to you, but I think it has some good points to consider. Now, for those of you that are wondering, why do we care so much about interest rates and why are we talking about inflation? What's the big deal? Here's the cascade. Clients have seen this. The threat is that if inflation rises above the Fed's target, which they have said historically is around 2.53%, the Fed could increase short-term interest rates, as they're talking about doing right now. The market often increases long-term rates. And then the value of financial assets, stocks, bonds, real estate, and crypto, are usually repriced lower. And it's kind of intuitive. If you just think, if you can earn 1% on your cash, you might think about investing that in bonds or stock markets to try to do better. If you could earn 5% on your cash, you might say, I do not need the bond market or the stock market. And that's an oversimplification, but it gets at the idea of why higher interest rates might pull investors towards, more safe assets and kind of put pressure on those price levels. We already talked about how stocks handle rising interest rates pretty well. Bonds often struggle in rising interest rates. So for example, if you have a bond, like many bonds now, that may be yielding 1% or 2%, and inflation is at 5%, you're going backwards. The money that you're getting is not keeping up with inflation. So that's an oversimplification about why investors would say, why, I'm not getting paid enough to own a bond that yields 1 or 2% when inflation is 5%. And then also in a similar way, if you have a bond that's yielding effectively 1 or 2%, and bonds in the market are available at 4% or 5%, well, how are you going to feel about your bond that's earning 1 or 2%? Not great. Say, wow, I'm going to go get that bond that's 4%. Again, oversimplification, but it shows how investors in bonds will say, look, I need to be compensated more for higher inflation or higher interest rates, and they will effectively sell the value of the bond down until that interest rate comes up. And that's what we saw last year, and that's what we may see, going forward. Sorry, just pausing for my slides here. So what does this mean for investors? When we're thinking about these threats, what's the so what? For us, we are not traders at Summit Hill Wealth Management. We don't think it's really possible to kind of time the market in December, out in January. But we think if you look at these, if you take a look at these dynamics, you'll observe, I think, some opportunities that other investors that maybe have shorter time frames maybe look past. And for our clients, we've talked about this. We're maintaining a tilt in our portfolio towards cheaper, more profitable companies. And in a low interest rate environment, investors tend to say, look, we like companies that have growth far, far in the future. And so for the past really 7 years, growth companies, even regardless of their valuations, have been the darlings of the stock market. We've leaned against that. And we prefer to look at companies that are less expensive. History would show they earn better returns. And the portfolio is kind of the stock market's kind of moving towards that view that we like these cheaper companies as well. Market is definitely moving towards profitable companies, and also international stocks are less expensive than US stocks. So to the point that was made earlier about valuations, is there nowhere to hide? That can be true, but even within the S&P 500, even within small cap stocks, and especially internationally, there are affordable companies that trade at reasonable valuations, that have good business models, and many of them pay a dividend. Those are the type of companies we've been tilting our portfolios toward. It's been out of favor for the last couple of years, and I tell clients, hey, this is common. We don't want to chase, the kind of the meme stock of the day. We want to position portfolios for good returns from 5 to 10 years from now. The market, I think, is coming around to our way of thinking right now, but international stocks are a good example of that. And the fact that emerging market stocks are actually holding up pretty well, year to date, when U.S. stocks are kind of taking a tumble. So is there no place to hide? I think, if you look below that, I think there are places that you can invest in. We are changing our bond managers. There's a real threat to owning bonds in this environment. And I'm not saying you should get rid of bonds, but I think you should be careful about how you position portfolios with bonds. Again, if you're earning 1 or 2%, inflation's at 5%, you're kind of upside down. And so we've changed bond managers and many of our client portfolios to basically adjust our exposure to interest rates. I don't want to get too technical, but if you look at the average maturity rate in a bond portfolio, shorter usually has less of a negative impact of rising interest rates. Longer maturity dates have a much more significant impact to rising interest rates that's negative. So we've already made a change there. And then also, one of the hallmarks of our investing approach at Summit Hill is that we like alternative managers that have a good track record. And so for us, we're very skeptical about them. But if they pass all of our screens, we like managers that can basically hedge a portfolio against major downturns, but has good, consistent returns. So we use a hedge fund that has an excellent long-term track record from the early 90s. And it's had very low, kind of negative periods in, say periods like 2001, 2008. So if you're not working with us, you're interested in what that is, I'd be happy to share more. Also, managed futures, I think, are a good replacement for bond exposure. We work with a managed future manager that's consistently returned around 5 or 8% and has, very little kind of correlation with the stock market. I like that as a replacement to bonds. So again, future returns, we're not sure what they're going to be. And I don't mean to imply that historical performance is, what's going to happen in the future, but we think there's a good chance that these kind of diversifiers could help. And then also we like private equity in addition to public equity. To the question before about, is there any place to hide? I like disciplined managers that are buying private companies at good prices. Again, the key is discipline. They can't be running with a herd and just putting money to work just to, fill out their fund allocation. But if you find disciplined private equity managers, they'll hold the line on valuations. Often you can avoid some of this crazy fluctuations. And I like being invested in private equity in the middle of major downturns, because once they occur, if the stock market's down 20 or 30%, that will affect private companies as well. And I want my private equity managers to have dry powder. So that's why we allocate to private equity through the market cycle. We don't try to time it. We allocate so that when these downturns happen, and this downturn may be transitory, it may last longer, but I want my private equity managers to have cash to say, wow, just like they did in 2020, all of a sudden, companies that were for sale at fairly high valuations in December 2019 and January 2020, if they were still for sale in April or May of 2020, suddenly the valuation and the conversation had changed quite a lot. For our clients that were invested in private equity in 2019, it may have seemed like an expensive time to get into private equity, but actually just 6 months later, it was a dream time to be in private equity. So we don't think you can time the market with that. We want to allocate consistently, but I love it. This may sound terrible, but I love it when markets go down quite a lot and we've allocated to private equity because those managers say, okay, we're going to buy some great companies. All right, I'm going to wrap it up just by talking about if you are running a private business. We don't just want to talk about from an investment standpoint, what does this mean for you running your business? I own a business. Most of our clients are business owners. I wanted to kind of share some of the advice that we have and that some economists we respect have. At this phase in the cycle, one thing that will come under pressure is your margins. And that's usually because your cost of everything is going up. Your cost of goods in the door and your cost of people is going up. So if you are, a manager kind of looking at this, if you haven't yet raised prices, if you haven't kind of had that discussion internally and made plans to raise prices and or to lock in, some of your cost of goods for long term, you want to think about locking in your margins. Things will get, kind of more expensive here, and it could be more difficult to be profitable. The other reason that profits, I think, are pressured right now is that companies that have done really well the last year and a half or 2 years are often tempted to say, wow, this is easy. We're amazing. We're doing so well. Look at our revenue numbers. And what they'll think is we're going into new markets. We're going to go into new markets. We're crushing it. Everyone's great. And the temptation is to go into new markets with lost leaders. I think this is a mistake. I don't think you should go expand into markets with lost leaders because often those just become losses. And it's that thinking, right? We've been crushing it. Now we need more markets to grow, whether geographically or other verticals. But I would be very careful. If you do expand, plan for profitability first. Don't fall into the trap of trying to take market share because it'll get more and more difficult from here. The second is focus on culture to recruit. Everyone's heard about how the Great Resignation is underway. Well, the Great Resignation also means the great job search. And so, many people are dealing with, kind of turnover in their own ranks, but you could turn that around and say, well, how can we kind of benefit from this? How can we be attracting people? So one, you're probably already trying to recruit people now. It's probably a challenge. The one thing that you can control is your culture. And the advice I will give that I've talked to a couple of friends who have done an amazing job creating culture is know what culture you want to create. And you've got to be able to define it, and you've got to embrace those trade-offs. Right? You can't necessarily focus on profits for the owner and be really generous to employees. That kind of doesn't make sense, right? So embrace those trade-offs in culture. Be clear about what those trade-offs are, and then implement them. If you say our employees come first, you plan a retreat, and then a customer says, "Hey, can I have a call in the middle of your retreat?" You got to decide. Maybe that is your culture, maybe it's not, but you got to do it. So focus on culture to recruit. Often there's things you can do to enhance relationships between employees that can enhance culture that don't have to cost a lot of money. Third thing is review your compensation packages to retain and attract. It doesn't necessarily mean that you have to pay people more. You can think about trying to give them more upside as the business grows, particularly for leadership positions. A lot of people that are go-getters like that opportunity to increase their compensation along with that. So if you're a business leader, it doesn't mean you just have to increase their base. You can come up with some good creative ways to give them upside as the business grows. And then scale for demand with growth. So if you're a business owner, you'll have more and more demand. If you have capacity, you probably can grow, but just be ready for it. Make sure the capacity is growing in a way that doesn't cut into your profits, and realize that growth trend, we may have hit kind of the peak. Don't extrapolate that 4 years in the future and say, oh, this growth trend is going to realize we may continue to have demand, but the growth may kind of roll over. So I'll pause here. We've got a few questions. So I'd encourage you, if you have questions, you can go ahead and type them in chat. I'll do my best to answer them. And we are still good on time. I want to be thoughtful of everyone's times. All right, so we've got a question on MMT. Is money supplied really a liability that needs to be paid back? So you may be familiar with, there's a new economic theory, which is the gist of it. It's called MMT. The gist of it is basically that a government can basically print an unlimited amount of money as long as their kind of cost of funds or interest rates is kind of reasonably near inflation. And so there's a lot of economists that are out there saying, absolutely, this is true. I think it's a bunch of baloney. One, it doesn't pass muster with historical experience. There's never been a country that could print an infinite amount of money and be okay. Every single one of those experiments added, kind of ended in basically, I think a credit crisis. So I've never been happened before. And I can think the key flaw of this theory is governments can create unlimited amount of supply as long as their interest rate is in this reasonable relationship with inflation. Well, they can control short-term interest rates, but they can't control long-term interest rates, and they can't control inflation. Um, so they can try, they can have interest rate policies, they can do this. So I think it's a bunch of baloney. I personally haven't seen a historical example of whether it's worked, and the fiscal policy theory that we just went over would say investors would react to that and say, that top number is exploding, but the government isn't making and taking any steps to increase tax revenue. So what's going to happen in the future where they're going to have less and less money to make even the interest payments? So I think logical investors will just say, that's a bunch of baloney. I think history would say that. So I'm speaking frankly, just for my own. I know there are smart people with PhDs that say, yeah, Eric, you're totally wrong. It's just my personal view, but that's my view on it. Darren said, was there no inflation after 2008 because the government raised the tax rate or because of secular economic growth, which raised the total dollar of tax revenues? That's a great point. I love the question here from Darren. So the government, did not implement significant tax increases, but what they did do is they actually implemented some austerity. You may remember that Obama and Congress kind of wrangling over austerity because there was this concern of hyperinflation. So even though there was, kind of an infrastructure plan, it was somewhat modest, but the government also benefited from this incredible boom in real economic activity, which did increase tax revenues. And so I think, again, if you're kind of a cold-hearted investor, you say, wow, US government tax receipts are actually huge. And if this, kind of easy money policy continues, companies and individuals will probably do all right. So another good reason to look at the fiscal theory of inflation and say, well, it's a good reason why inflation didn't go up. So great point that the kind of boom in real economic activity can increase tax receipts. One of the questions we have right now, if we apply that to right now, is if we continue to raise interest rates, will businesses have as much kind of a tailwind behind them to grow as they did after 2008, 2009? And the answer is, well, it's hard to grow as well in a rising interest rate environment as it is in just a flat kind of zero interest rate environment. And so if investors are looking at that and saying, well, that would slow economic and corporate growth for companies and also probably tax receipts for individuals. Therefore, the government may have less. Therefore, we might be concerned about inflation. So if we take that same idea of real tax revenue and apply right now, the government actually may have less, not only because they haven't increased tax rates, but because companies and people may not do as well with higher interest rates. Jason asks, when was the last time international markets equaled or exceeded US market returns? They range between terrible and extra terrible. You are right. I do not have a chart here, but I'm happy to share a chart. Basically shows periods where international stocks outperformed US stocks. And really from the 60s onwards, there were multiple periods where international stocks outperformed US stocks by, 50, 100, 150%. And I know it's hard to believe. Now, historically, those periods were shorter than the periods when US kind of dominated international, but they're still there. And from an investor standpoint, they're meaningful. If you were to test them for significance in a statistical way, they have statistical significance. And the period of US outperformance over international is the longest and the highest in this period of reporting. When we have good data, it goes back to about the mid 60s, we have good data between international and US stocks. So if you're an investor and the asset class that has done the best over the last 12 years, US stocks, has had its longest period of outperformance and its highest period of outperformance, and it's the most expensive, here's the question of the day. Would you want to buy more of that? Or would you want to buy some more of the asset that has outperformed, is less expensive, and is out of favor? If you're a trader, you say, I'm going to ride the trend. I'm going with US stocks, maybe US growth stocks. If you're an investor, I would say, maybe we think about the asset class that has experience or has a track record of outperforming is less expensive and out of favor, because generally, whatever asset class led the last decade will lag this decade. So for sure, particularly US large cap stocks, they did the best in the last decade, historically, you would say they're probably not going to be the number one performing asset class. And when we look at history, there's a chance it'll be international. And Jason, I'll make a note. I'm happy to follow up with that chart. So great questions. So anyone else have any questions? Happy to answer them, happy to type them in. And then also, Michelle, if you want to unmute anyone, feel free to share a question if you prefer to say it rather than chat it. All right, I'm not seeing any other chats. One more call if anyone does have any questions. Okay. All right, we will pause. If you didn't get a chance to ask your question, or if you'd like to ask it privately, you can contact me. My personal email is ewalters@Summit Hill Wealth. If you wanted a copy of our slides, we're happy to provide them. Just email info@summithillwealth.com. And as I mentioned at the beginning, if you have questions about what your own plan is, if you have questions about how your portfolio will deal with these opportunities and threats, we'd love to chat with you. I'm happy to take a look at your portfolio and just offer observations with no expectations. If you are a client, we appreciate that. And if you are one of our strategic partners, we appreciate that as well. So we'll end here just a few minutes early, but appreciate your time and have a great day. Thank you.